Yes, my name is Marius Schöner. I'm heading CBRE Global Investors since 4 years. We are very much focusing on commercial real estate. We are looking for office buildings in the big 7 markets. We are investing into retail as well as into logistics.
Okay, great. Nicholas.
Nikolai of NAS Invest. We've been buying office properties and medical centers a little bit below the radar of large institutions. So typically in the 10 to 30 million range across Germany.
Okay, great.
Good afternoon, everybody. My name is Tobias Schultheiß. I set up Blackbird Real Estate, a transaction advisory boutique in 2011. So we're 7 years old and mainly focusing on sell side advice whenever investors want to sell real estate in Germany. Not necessarily in the top 7 locations. We much more prefer going to C, B, and D locations with smaller properties like Nikolai intends to buy.
Okay, great. Ilka.
My name is Ilka Garmhausen. I'm tax advisor and lawyer at RSM. And within RSM, we have our real estate European group in which we aim to support our clients in cross-border developments and investments to provide them with the local knowledge in taxes.
Philippe Lapierre, LaSalle Investment. We are a global investment manager. We manage about $60 billion across the globe. A large majority of that on the continent of Europe as well, where we cover primarily the commercial space, i.e. retail offices and logistics as our primary focus. In Germany, we have an office in Munich of about 40 people and cover the range of core plus, and are sniffing into the value-add space in order to get value out of the German market.
Okay, great. Let's start with you, Nikolai. The economy looks pretty robust, really, in Germany. Good performance. How do you see the outlook at the moment? Do you still see sunny skies for Germany? Do you think everything is rosy in the garden? What's your view?
It all depends, as always. So what we've seen in our portfolio is strong demand from tenants. Typically tenants that come from the Mittelstand, so the mid-cap companies in Germany, that are usually operating on a global perspective. So that means they are seeing robust demand also from other parts of the world. Now we all know about the tendencies that we've been seeing, like trade wars and the potential rift that's going on with the US. So obviously Germany as an export nation, there is the risk of losing part of those exports and that potential. And I would say I would need to take a crystal ball to say it's going to happen or it's definitely out there. But I would say for now we're seeing robust demand from our tenants, and I wouldn't expect them to take on additional space if they hadn't a positive outlook into the near future. So that's our take, and that's why we think it will continue as it has been now for the past years.
Okay, good. And Marius, in terms of CBRE Global Investors, what are you seeing in terms of, I guess, the fundamentals? Nikolai there mentioned occupier demand. Do you see that as a strength, particularly in the sectors that you're looking at?
Yes, I think covering the 3 main commercial sectors and starting with offices. In offices, we see a pretty strong demand across all major markets. We see historically low vacancy rates. And we believe if we look into the future that this is going to persist for a while. So we are we believe in rental growth across all of the major German office markets. When it comes to retail, it is a different picture, especially when it comes to shopping centers in non-dominant locations. The rents are under pressure. We see the structural shift which is coming through by the e-commerce. And I think we will see that we need to find a new equilibrium between the shopping centers and between the e-commerce, and this is underway, and this is causing some concerns among investors. And finally, maybe just on the logistics side, logistic market is very healthy. Occupier demand is healthy. There's a scarcity of logistics space, and on the other hand, we see that we have strong demand from investors, but generally from an occupier base, it's a very healthy sector.
Okay, good. And Philip, you're obviously looking at it within Europe. So you're seeing Germany within that context. How do you see it in comparison to the other countries that you're looking at, or let's say the German cities within the context of the other European cities? What's your overall view in terms of Germany within that wider European context?
I think you need to look at the continent less in borders, but more on cities. So we concentrate on ideas of the so-called DT, E and U, so the idea of where's the demographic growth, where's technology, where's the environmental issues being taken care of. Those are the main drivers of the cities in the future. We have a strong urbanizational movement in Germany, but across the continent. Germany might not have that one central economic power like Paris or London, but it has the advantage of having 6 or 7 diversified and also strong underlying economies. So in a continental scope of cities, I think Germany is profiting on that federal growth system, which gives it a downside hedge. You will never have an impact like potentially a Brexit on London, on one city especially you won't have a Brexit impact on a German city, but that kind of a principle. So you've got your finance in Frankfurt, you have your tech in Berlin, you have your Lederhosen in Bavaria, and you have your trade in Hamburg. So you've got a lot of centers that make a lot of sense. On top of that, in a European context, if you look at the livability and the demand where people want to work, where they can travel, where they can fulfill their work-life balance, the German cities are usually in the top 10, if not in the top 20 across the board. So all those parameters looking forward for the next 10, 15 years on the basis of demand and supply, especially on the office sector at the moment, gives a very solid growth scenario for the German office market. Retail, as Marius also said, has a bit of a cliff potentially looming going forward. Germany's also centralized on the continent. That means the pathway of goods will always travel through Germany to a certain extent. And even though if we believe that all logistics is only retail, 80% is still your normal distribution and manufacturing, which Germany also is strong. So good balance of demand and supply, a good, healthy living environment to work in. We are getting better at integration. Better, not good, but better. So there are many fundamentals speaking for the German economy, for the German real estate market. But ideally, it'd be great if you could just go put your money somewhere else. I was just hearing that Greece is a wonderful place to go. You don't really want to invest in Germany because there's enough capital here as it is. And the pricing has reached a point where finding value is becoming a true challenge. So go invest in Romania, I hear, is wonderful as well. But it's a tough market. It's a well-priced, transparent, and extremely liquid, but very transparent and highly priced market at the moment. So finding value, and I guess you get onto that in a minute, is the biggest challenge at the moment.
Okay, good. And Tobias, just to come to you, I mean, picking up that point there from Philip, where you've got these large cities, you've got an increasing trend for urbanization, I mean, across the world, not just in Europe. You were mentioning there as well that you're looking at those smaller cities. Is that trend for urbanization still happening in those smaller cities? And what does that mean in terms of the opportunities that are there?
Actually, I don't see a trend to urbanization in these smaller cities, because they're like smaller cities, meaning between 30 to maybe 50, 60,000 inhabitants. And they don't really grow, but the healthy ones don't get smaller as well. So they have their urban structure, and it may not be set for the future, but I don't see urbanization. In terms of finding value there, I don't agree with you, Philip. We don't have to go to Romania. We can go to Limburg or Nordhorn, but I understand this as...
That's around the corner, Romania.
Now, in terms of finding value, one has to understand these smaller cities, because obviously when you're from abroad, you know Hamburg, Frankfurt, München, Stuttgart. Maybe you know Cologne, but you don't know cities like Gelsenkirchen or Limburg or Nordhorn. But there's a reason why these cities exist. And you have to pick out those that have a healthy democratic situation with a low unemployment rate. And you can buy their properties at much higher yields compared to the top 7 cities. For example, 2 weeks ago, we arranged signing for property in one of the top 7 cities at way below 3% gross initial yield, which is ridiculous. But it was for a family office who just wanted to get his money out of the bank account. But when you go to these smaller cities, you can buy properties at way below 12 times the rent, say in excess of 8% gross initial yield. But I cannot recommend to go to these cities unless you have a good understanding of these cities, or at least advisors who assist you in finding these properties in that cities.
Okay, good. I'm going to come back on that in a minute, but one of the interesting things you pointed out there, Tobias, was maybe the types of capital that are beginning to look. You mentioned their private money. Ilka, you'll be seeing in terms of the advisory side who's coming in. Are you seeing more within the German market? Are you seeing what are you seeing in terms of the mix of domestic investors versus Asian investors versus US investors? Are you seeing, or have you seen a change in that over the last year or so?
Yes, of course. What we see is that the Asian investors are currently very strong in Germany. But also our clients are are located at the middle market in Germany, and family-owned offices who invest. So I think the inbound business has become very strong. But from the tax perspective, I think the climate becomes more difficult because the tax authorities have in mind what they consider as abusive structuring of building up a real estate company and selling shares. So we see the proposal of the Conference of Finance Ministers to sharpen to reduce the threshold for harmless share deals. So I think it becomes more difficult in Germany from a tax perspective. But at the moment, this law. Yet there isn't even a draft for this law, so at the moment I think we have a time window where we can rely on the current threshold of 95% minimum for a share deal, which doesn't trigger real estate transfer tax.
Okay, good. I mean, I have to confess that I'm not as up to date on tax affairs that are going through Germany. Is that something that you're thinking about as investors? Anybody feel free to come in on that. What's your view on the taxation? Does it give you an advantage? Is this about the listed? What's your view on it?
So we typically structure our investments via Luxembourg, simply because we have a large number of European investors participating in our real estate acquisitions. Now we're looking at a deal that is already kind of owned by a Luxembourg company. We're not going to buy that Luxembourg company simply because of those tax reasons. We're going to set up the exact same company in Luxembourg simply because we don't want to be exposed to any real estate transfer tax risk. And then obviously it's a matter of pricing. But I think what's happening there with respect to the legal changes, it is having an impact on the market, and it's definitely changing investor behavior.
Did you want to pick that up, Marius?
Yeah, well, I mean, we structure our investments usually either through German holding companies or Luxembourg companies. Overall, I think what we do not do any longer is to underwrite that we share at the time of the exit the capital gain tax, because we don't think that would be available at the time in exit. Yeah? So I think you have to be, we have to be more careful, more conservative with the underwriting of assets in Germany. We assume that we have full taxation at the end. Obviously, there are ways to optimize the running taxation, and still there's a way to optimize the real estate transfer tax, but it's getting more and more difficult, and ultimately I think you have to assume that you pay real estate transfer tax, and you have to assume that you pay full capital gains tax at the end.
Okay, good. And Philip, I just want to come back to that capital side of it. In terms of the capital that you've got coming into your funds, what are they saying to you in terms of Germany? You mentioned Brexit. We fortunately, for the first time, I would have to say, the previous panel, which was on logistics, we didn't mention Brexit at all, which is the first time that that's happened in now almost 18 months. I think that it's not been mentioned at any panel. But are you seeing a shift, let's say, from investment capital that was looking at the UK that is now looking more closely at Germany? Is Germany more of a first port of call than the UK now?
I don't think you can see that in numbers in particular. I think it's always been a side-by-side movement. I think Germany has caught up on the investment volume to the UK and France over the past 3 to 4 years, which shows the robustness of the market. I think if you look at the German market presently, you've got to be aware of the fact that your pricing going in is extremely steep. And the one thing that you have to look at nowadays is, where's my income stream? So my focus is no longer on the history of Germany, inward yield shifts driving my capital growth simply by holding on to the assets. So that expected automatic increase on cap value, I doubt will take place, simply because we've reached a threshold of yields, especially in the core, but also towards the core plus and value add markets. That focus has to shift to the income streams. The income streams is what's going to create your value. And you can see that by the amount of capital being raised for Europe, for that value add space, in order to create a value moving forward. So I think that's the most important thing. Germany is extremely priced due to the capital flows. And I don't know if that's driven by capital that would have gone to the UK and is taking a breather to see what happens in March. I think it's simply due to the fact that the economy is strong, the demand and supply allows for the idea of rental growth moving forward, and there being some potential uplifts along the way. So I think that's where the majority of the drive is coming from. And we're in a very professional market now. We've got 5 years of continuous capital flows into Germany. Transparency, professionalism, the understanding of the federal system has all been anchored and absorbed by the different investors. They see the pros and cons of that kind of a market. And it's still good quality and good locations, potentially underpriced to other markets like Paris, London, or even Spain in certain situations. So it delivers value, and the whole capital stack is present. Your financing is positive, your mezz financing is there, your asset classes from student housing, the residential suite, your risk classes, they're all there, they're all liquid. So it's a market that you can go in, potentially create value, and don't have a fear of being stuck in due to its non-liquidity, not being liquid. There you go.
Illiquid is probably
illiquid. There's a good word. Illiquid.
Yeah,
it's not an illiquid market.
And Tobias, what about? You mentioned that you and Nikolai are both looking at that kind of secondary, tertiary sort of sectors. Is the same true there in those sectors in terms of liquidity, in terms of buyers wanting to come in? What's the situation? And obviously it's potentially going to attract to a different type of capital simply because of the sort of lot sizes. So what sort of capital is looking there? You mentioned private wealth, but are you also seeing a lot of international investors trying to come into that part of the market?
I don't see too many international investors looking at this market, because other than what Philip said, those secondary markets or even smaller markets, they're rather illiquid. Which on the one side is rather bad, because you don't have a big group of potential buyers when you want to exit. But when you are on the buy side, it's the positive aspect that due to this illiquidity, the limited market of buyers, you can negotiate very affordable prices. For example, we last year we bought a property in Nordhorn on a WALT of 5 years. Good quality tenants. 50% of the rent comes from the federal state of Germany. With a WALT of 5 years, I already said, we bought this at 8 times the rent, 12 times gross initial yield. Same story with a property in Limburg we bought last year. So, but you have to be aware that you pay at a high income stream, at a high yield, but I don't see a local buyer going into these properties because they're too small and then not on the high street of these cities, but in commercial areas. So that's the illiquidity of this of these sectors. Who are the possible buyers for it? It's NIS Invest, but I don't want to talk for Nikolai. I do see some German private, family offices, private investors who don't want to buy on their own, but say, okay, if I find a team that that focuses on this, that has professional asset and property management, then we would give money to this platform and co-invest with these people, but not international money.
And Nikolai, so let's have you speak for yourself. What's your view on that? And because of the structures that you're looking at, you mentioned that you were reaching out to international investors who want exposure to that kind of area. So who's looking and what are they looking for?
So first of all, the assets that we bought were not necessarily in Nordhorn or Limburg. So we bought in Berlin, Hamburg, Hanover, here in Munich by the airport. We bought in Dortmund. So those are markets that are, in my view, very liquid. They're liquid for locals. They're liquid also for other market participants, not necessarily the very large institutions that have kind of limitations on where they can go and the type of asset class they can invest in. Obviously, those are not properties that are always in CBD, but they're in very good micro locations that make sense. And that's exactly what people that go with us would like to see. Basically, additional value from us being a manager and an investor in such assets. Because one coming from other parts of Europe, or potentially also from other continents, would not necessarily understand the dynamics of these local markets. And that's what a local manager, what a local investor can bring to the table. And then you can find good value there. Yeah, that's what we're doing through our funds, which go through Luxembourg, obviously. But eventually, it's basically about creating the value, like Philip said. And real estate is still a people's business. It's still a local game. It's still a business where you need to have the expertise. And if you're coming from abroad, then obviously it's hard to bring that across. And that's why people go with us.
Okay, good. And in terms of Marius, what sort of opportunities are people looking for? Is it value add? Is it across that area? Is it core? And are there particular areas? I mean, Philip already mentioned that it's already too competitive and we should look at Romania. And I'll do one on Romania tomorrow, so anybody come back for that and I'll put you on the panel, Philip. But what's your sense of that? Where are you finding the opportunities for the types of capital and what opportunities are there?
Yeah, I mean, we are our investor base is very much international, so our investors won't go into the locations which were mentioned into secondary cities in Germany. We are generally convinced that we shouldn't take location risks. So the assets we are buying are in strong locations in the big 7 main metropolitan areas. However, I mean, since many of those assets are fully priced, this is not the assets we are looking for. Yeah. So what we have done in the past, we have looked for assets with low rental values and which are in the city center and which offer potential for modernization or for additional investments. We have looked for investments which offer the possibility with a change of use to create extra value. And just to mention a couple of examples, I mean, for instance, we bought a Karstadt property in Düsseldorf. This was leased at a very low rent of 12 euro per square meter per month. So an investor who invests into this property can have a very nice cash flow on one hand, But if something goes wrong with the tenant, you have the opportunity to turn this property into something else and realize even a greater value. Yeah. The most recent acquisition we did is the Hanseviertel in Hamburg, which is a piece in the city center where rents in the office sector are half of any of the rents in the surroundings. This is an asset which is mixed use with a hotel, with a retail gallery, which needs some repositioning. And these are the kind of opportunities we do, and we have invested into human resources over the last 4 years to build up this kind of expertise in our team. And this is where we see value for investors.
Okay, good. And Ilka, I just want to look a little bit at locations. What are you seeing in terms of the demand coming in from your side? Are you seeing more people looking at Berlin versus Frankfurt? Or are you seeing, as Philip mentioned, that there are these large 7 cities essentially, and it's fairly evenly spread? What's your sense of that? Certainly in the events that we've been running, there's been much more of a focus on Berlin than there used to be, let's say, 3, 4, 5 years ago. Are you seeing that coming through?
I think I'm the wrong person to ask this, because we are located in the north of Germany, and our clients actually mostly invest in smaller cities as Wiesbaden or Heidelberg and something like that. I can't say something about the investment in Berlin. Sorry.
So you're seeing people coming into the smaller cities. Philip, what about you? Berlin still lacking an airport, as far as I understand. What's happening? Do you see?
It has Tegel. It's got a great airport.
Do you see? I mean, my sense of it is that Berlin at some point will become a true capital city, rather like London and Paris. Do you think that's not going to happen because of the federal structure, or do you see the potential for that?
Berlin has potential. Berlin is showing on the rental side is growing potential. Is it ever going to be a city like London or Paris? I doubt it, simply due to the fact that a lot of the industry will be situated in different cities in Germany. I mean, if you add it all together, all the German cities, you then get your Paris or London. So I very much doubt that. Does it still have a long way to go? Is there still attractiveness to Berlin? Sure, to a certain extent. But I think there's breaking points as well. If you look at rental growth and if you look at costs of living in these cities, Berlin has always had that flair of being poor but sexy. If you now have to be rich in order to be sexy in that city, you might just have a turnaround. This might be a long way off. This might be a 10-year kind of vision. But it is being constrained. It's being constrained in where to live. It's being constrained in where you can work. It has potential. It has a unique lifestyle. It has a unique flair, and people love the city to work there. But are they going to work there for 30, 40 years, or are they going to work there while they're 20 to 25 because it's great to go to Back High and Kit Kat Club and get stoned on the street? I don't know. No? But there's a uniqueness to it and a singular flavor to it, which if that has a long historical growth and if Berlin can grow into that depth to provide everything, it might have that chance. But it's fighting against a federal system, maybe even a German historical idea of Berlin's view in itself. But again, if you look back to where opportunities are, you have to be able to understand a city. And I think Nikolai was saying that, core has been priced. If you go in 3%, what are you going to do? I mean, unless it's truly under-rented, you aren't giving your investors back the returns that they need for any kind of real estate investment. So you've got to understand these cities. You need local knowledge, you need research, you need to see where things are going. You might be able to go off the beaten track to attract some of those tech companies. Berlin is good at that, but other cities have that possibility as well. Find a unique building that attracts a single kind of tenant. And maybe you don't want the cubic glass and steel assets anymore, but want to go into brick, mortar, and the WeWork, the other lifestyle kind of assets. Find that unique asset, and that's where I believe the rental growth in those locations, in its connectivity, in its technological drive, and if its infrastructure is correct, that's where the value is. The difficulty is there's so much capital looking at these locations and in giving transparency that gap, that value is being squeezed out as we speak. So it's, you've got to have the capital now, you've got to have an aggressive view on where you can take it, you've got to have the ability to give that building the color and the feel to be competitive and to show that rental growth higher than your competition down the line. So does it have connectivity? It's an essential bit of whatever you're leasing now. If it has that, if it has the exposure, if it's maybe even in a residential area that is hip and funky and they all walk around with their sandals and whatever they do, these millennials. If it's for them, that's where you want to go. Yeah, you've got to pinpoint. You've got to know where you want to be, because swimming with the tide in the pure core 10-year lease, it's a tough one. Yeah, where do you create the value at the end of that for your investors? And that's where our focus lies.
Okay, good. And
nothing against millennials, of course, especially here in the crowd. You're a great bunch of
maybe
people.
If I can add to that, because I was born and raised in Berlin, and one of the few. Spent some time abroad, spent some time in Frankfurt actually, so I know that city also well.
Is that abroad?
And yes, for Berlin, yes. But I would say probably the truth lies somewhere in between, and I would underpin this. Berlin is, in my view, also not going to become London or Paris, but it's definitely on a good way to becoming a cosmopolitan city in Europe. And if I compare basically what I've seen 10 years ago to what I see now, and I've been in Berlin again since 2011, then it really, it makes me proud also to some extent as an original Berliner. Now the question is, is there going to be a correction? Yes, I think there's going to be a correction also at some point in Berlin, simply because you've been seeing new industries that create jobs there. What happens if maybe some fall? And there's going to be market consolidation also in the tech segment. It's simply going to happen. No one knows when it's going to happen, but it will happen. And obviously, it's also going to have an impact on real estate in the city. Now, with Frankfurt, it's a different story. But in general, if you take it long term, then I wouldn't see why, there is no reason why these cities should thrive, or should not thrive, sorry. There is definitely a reason for that, and it really comes down to the cycle, and there will be a cycle, a dip again, and then there was going to be an upward trend once more, and that's basically where one should participate.
You want to pick that up, yeah?
Yeah, I think the key question is, everybody is convinced that we have a low vacancy rate across all German cities, and that's pretty evident. So we see rental growth for the next 2 or 3 years. There's no doubts about it. The question is what is happening thereafter. And the question is, when we have historically high prices, historically low yields, the question is this going to persist? Are we rising the prices for German property to a different level than where it used to be in the past? So is it just a cyclical thing that we have suddenly high prices, or is there a structural driver behind it? And my view is that there are, at least for some of the cities like Frankfurt, like Munich, that there are structural reasons which make me believe that to a certain extent the prices, at least for land values, won't go back. And the reason is that different to 15 years ago, and I take Frankfurt as an example now, because Frankfurt is one where everybody say, well, vacancy rate is still at 8%. But if you look what happened over the last 15 years, 250 hectares of land were built out, which was former railway land, which was former harbor areas, which was former military areas. And this is all built out. This is 10% of the inner city of Frankfurt. This is no longer available. You see a competition of space between residential space, between office space, which you haven't seen in the past because rental levels were too low. Now a lot of assets are converted into residential. And so fundamentally, the lack of land and the lack of available space in cities like Frankfurt and in cities like Munich make me believe that prices won't go back so easily for real estate. Yeah.
Okay, good. And Philip, in terms of LaSalle, obviously in the US, a much more mature market for residential, for multifamily as it is there for residential, also for student housing, for senior care. What's your sense of that market? Is it people chasing yield? Is it part of a structural shift towards more residential, more student housing, more senior living? What's your sense of that? Is it an opportunity or a bubble?
In the US or in Germany?
No, particularly in Germany.
In Germany. Residential, I agree. Again, what Marius was saying, it's an urbanizational trend. Yeah? So the big cities will grow which again makes me question how the B centers will accommodate that. So if everybody flocks into the big cities where your capital values are driven by an increase in demand, they've got to come from somewhere, and they're probably going to go from B to A, if that's where the jobs are. Healthcare, I think there's a big structural difference between Europe and the US concerning healthcare or your golden agers. In Germany, you want to die in your own apartment, and in the US, you want to die in Florida. So the difference in that being you have operators specialized on that golden aging, on that flexibility. In Germany, it's just, you got to have a good asset manager to pull the people out of the apartments. And you don't have the professionalism of the operators that you have. It's a different legal structure. It's privatized in the US. In Germany or in Europe, there's a lot more stately controlled, and the state legislation has an impact on it. So it's a very different dynamic and a different covenants involved at the end of the day, depending on what you're looking at. So I think the whole healthcare segment, I think it's an interesting one. I think it's because the aging issue, especially in Germany, is an up-and-coming issue. And we're not getting any younger. We're just getting older, as you can see with the pictures. But at the end of the day, you need the operators, you need the professionalism, and you need to find exactly that product that's going to work in Germany. And I haven't seen it over the past 10, 15 years. On the residential side and student housing, I think it's a fantastic product. It's still, but at the moment for institutional, are you going to build those assets yourself? Because the supply isn't there. The operators are already linked to a majority of the institutional investors, so getting access to that product is scarce and it's difficult. And it also depends on where is that demographic going to go? How much do you actually need? And what are the costs of those apartments? So it's a risky space to be in, and you need a deep knowledge to be able to be effective in that. But if it takes some pressure off some of the more standardized institutional products, it'd be a good thing to have if it professionalizes and keeps growing or keeps getting deeper in its importance for the market.
Okay, good. And just, Tobias, to you, what's happening in terms of financing? I mean, Philip mentioned that financing is available. What's happening? Is that also true in the secondary and tertiary sectors, areas, locations? What are you seeing there, or is it really mainly available to full equity buyers? What's the position?
Well, it's quite easy. If you want to have 100% purchase price finance, you can get it. I bought a property last year at 100% LTV. Just recently, together with partners, we bought a property, 12,000 square meters of office space in Bochum, which is also one of the secondary locations in Germany, where we got almost 90% of LTV, and it wasn't one bank we talked to. We got term sheets of 4 different banks, so we had a choice. So financing, even in smaller locations, is not the issue. And it's not only the Volksbanken or Sparkassen in the respective cities, it's banks from all over Germany. For example, one bank that provided us with a term sheet for the Bochum office comes from the Lake of Constance, some 700 kilometers south of where the property is. So finance is not the issue.
Okay. Sorry, but was this non-recourse financing 100%?
Limited recourse, 10%.
Okay, good. Just finally for you, Ilka, are there any? You mentioned the tax structure, obviously, that may be coming up. Are there any other legal or tax areas that international investors should be thinking about?
One issue I can think about is the change of the property tax. This is an issue which mostly doesn't interest the investor because the property tax can be passed on to the tenant. But now there will be a change in the calculation of the property tax, and that will make the property tax probably increase extremely. And so I think the renting will become also more expensive for the tenants, and so I think you have to keep in mind that also this is an aspect that has to be considered.
Okay, good. We're right up to the end of our time here, so I've got one last question, which which is about where we should invest. So we can boil all of this discussion down to where we think is best. Let's start with you, Marius, and we'll finish with you. And I'll skip you out, Ilka, because you'll just say that you're a tax advisor, so that's fine. Marius, where should these good people be investing within Germany? And let's stick to real estate.
Yeah, okay, fine. Well, as I was saying, I mean, we are looking and we think we see good value in properties in the inner city of the major metropolitan cities, so the big 7 German cities, where you have low rental values and where you don't expect to capture the rental growth within 1 or 2 years. Yeah? So you should be prepared to buy into a property with a low initial yield, and when the time comes that the property is to be released, then you will capture the rental growth, and I think the rental growth will persist for a while. But when you look for properties which you can turn in 1 or 2 years, you're competing with the developers, with the German developers who start developments with 10% profit on cost. You're not getting what you are looking for. Yeah. So look for longer-term leased properties at a low rental value. That's my recommendation.
Okay, great, Nikolai.
First of all, I think it depends on the risk-return profile. If you're more risk-averse, then please go ahead with this strategy. I think it makes total sense. If you're a little bit more risk-dynamic, then I think it could also make sense to go to markets that are not necessarily core markets or A markets, and definitely also where some work needs to be done. And I strongly believe in the office asset class in Germany. I think we'll see further growth. I don't think that we will go or that we will see similar situations like 10 or 20 years ago where we had corrections in the office market. Simply too much of a demand overhang and undersupply going on for several reasons. So in terms of the asset class, I would strongly support office properties, yeah.
Okay, good. And Tobias, as EXPO REAL goes on, and we're now heading towards midway through the afternoon on the second day, I find that I've had a massive sugar crash. But what that means is I become much more susceptible to risk. So you can tell me a high-risk strategy if you like.
It's not a high-risk strategy, but it's just properties with a higher income stream because you can buy them cheaper compared to the top 7 cities. And as an investor, I follow 2 paths. The one is what I call properties with business park character, say office and warehouse from the use side. But I focus on granular tenant base, at least 10 different tenants. So you will never have a full loss of the income if a lease contract runs out. The second path is, what everybody looks for is value add, but also not top 7 cities, rather smaller cities at around 50,000 people, anywhere in Germany.
Okay, Philip.
First of all, I would invest with LaSalle Investment, not CBRE GI or the other folks here on the table. I still believe in a core plus strategy. The reasoning being I believe in the rental market, so I believe in the office market. I have a bit of a difficulty judging construction costs into the future. So any kind of value add play that has investment potential and a large bit of that business plan being restructuring and investing. It's an extremely tight market on who you actually get to support you on that endeavor to fulfill that business plan. Plus judging those costs now in the next 2-3 years, you'll probably be off. So I think a leasing risk profile I would definitely go into in the big 7 markets, maybe even the top 9. And I would look for the assets that are a bit more unique, that are a bit more, have a bit of a differential asset or type or style to them than your typical glass and or your normal bricks and mortar. So a bit of a colorful differential to the rest of the market, leasing upside, and potentially, not too much on the restructuring on the costs, unless you have a good team in place that can deliver that service, because it's extremely difficult to get at the moment.
Great. So we now know all where we should invest, where, when. Excellent. Thank you.